doing interior design. I think that's pretty cool though, especially because uh, for our people, like now we can see a different aspect of life, as opposed to, oh, he got money because he's driving, a fancy car and got on flashy clothes, but comes home and sleeps on a slice of toast. You can show him coming home sleeping on, like an ultimate luxury cloth mattress, the one that's from Bloomies for 50K. We gonna get there. Ours is only 15, but don't worry, I'm gonna get to the point where I'm buying a 50K mattress instead of a 15K mattress. Anyway, yo, it's your boy, the insurance junkie, your fiduciary fella, the all-star advisor Alonzo Hall, and today I'm talking a little socioeconomic Saturday, and I want to talk about which is the best life insurance policy to buy. Before I go in, ladies and gentlemen, make sure you hit that like, drop a comment, subscribe, and hit that notification bell so you're made aware every time I release new content. And as always, share, share, share. Lastly, to contribute to channel growth or to schedule an appointment with a licensed financial professional, the links are in the description of this video. With that being said, it's ironic because I just noticed something, especially with the African American community. So we was talking just now, me and my wife, because we was watching MTV, and now the rapper Cameron has a show. He's an interior designer. His haircut, actually, this facial portion does look very nice. Okay, I kind of like this dude. Hey, Miss Queen. So, with that interior design and things of black people, this is going to be a little graphic, but I'm going to show y'all anyway. So, we like labels. So, here, as you can see, I haven't made my bed, but that's CK for Calvin Klein, right? Now, those are the pillows that I sleep on. Because I also sleep on Calvin Klein sheets and Ralph Lauren sheets and also Walmart sheets. I ain't gonna hold you. We switch sheets and stuff. But I also want to show y'all this, right? Because all I wear is Calvin Klein t-shirts and all I wear is Calvin Klein underwear, right? But it's very unassuming. Folks see me and think I'm broke because I wear a t-shirt and jeans all day, every day, right? But the mattress that I sleep on, like I was talking to my wife about, is $15,000. So I sleep on people's gently used car on a daily basis. Now, what do you think depreciates more? My $15,000 mattress or that $15,000 car? What do you get more use out of? That $15,000 mattress or that $15,000 car? Knee-jerk reaction would say the car. The reality is you spend more than 30% of your life in bed. See, in the car, yes, you go places. However, in the bed, you sleep for at least 8 hours a day, right? And that's going to be every day. Now, in terms of the usefulness of the usage, it may be more useful or seeming more useful or have more utility with the car. But simply put, you sleep every day. She said, you sleep about 5 hours? Well, you're supposed to get 8 hours. But even if you do sleep 5 hours, the amount of time that it takes for you, or the amount of times that you have to go into your car to get 5 hours of use, unless you drive to work 2 hours one way per day, so that would mean 4 hours a day, it usually takes about 3 weeks because we drive in increments of 20 minutes to a half an hour. Well, you different, Miss Queen. If you driving for a living, that's very different. At any rate, I say all that to say this, because like I said, I'm a label whore too, right? And so it's the subtle labels, though, right? Now, there's also reasons for certain labels, right? And so that's what I'm getting to ultimately. So one would say, well, you know, $15,000 for a car. You may have a high mileage car, and here's the problem. Also, with that car, you spent more than $15,000 on it because you have to pay tax, title, insurance, registration, gas, maintenance. So it ends up costing you more money in the long run, right? The bed is a one-time purchase. That's it, and then you have it for at least 10 years. But over that course of that 10 years, the only upkeep is was good knowledge in relationships. The only upkeep is you know, shit like these flashy Calvin Klein ass pillows. But at any rate, I want to talk about the best type of life insurance policy to buy, and it came to me uh, in a revelation recently while dealing with some of my clients. And the best type of life insurance policy to have is one that's in force at the time when you need it. So at the time a person either needs living benefits that may be a part of your life insurance policy, whether that's term life, whole life, universal life, index universal life, variable universal life. You have those options available to you. So it don't matter the type of policy that you have, as long as you have one in the event of your death or disability. That's all, that's it. Now, there are situations where certain policies best fit other people. So I'll give you an example. If you have a budget of under, depending on your age, I'm going to speak to the demographic that's my age range. I'm listening what's going on. And ladies and gentlemen, if you're enjoying the content, make sure you hit that like, drop a comment, subscribe, and hit that notification bell so you're made aware every time I release new content. And as always, share, share, share. Lastly, to contribute to channel growth or to schedule an appointment with a licensed financial professional, the links are in the description of the video. Char Willie, good morning, salute. So, as I was saying, the revelation that I've come to is that as financial professionals, we have niches. And in those niches comes very important things when we're dealing with specific clientele. What do I mean? Well, if most people, most regular people, and now I understand why you'll have things like Dave Ramsey and Primerica who force buy term invest the difference. Because I have now in my book of business, I have a range of clients that a lot of these different concepts make a whole lot of sense. So I want to also shout out my boy JT the Pocket Watcher because he's one who actually was able to have this conversation. He was talking about infinite banking, and there were a lot of insurance agents who called in, and they got demolished by a CFP who doesn't even have his insurance license in insurance. And it was, is this my cup of yours, babe? This one's mine. Thank you. All right. Yeah, I got the red cup, so I didn't know which one was which. Oh snap! Hold on, I need to. Where's my what? No, I have it right here. I was just responding to a text right quick. I'm at the water cooler, y'all. I had to give me some water. I took my meds this morning, babe. You know what? I didn't take my multivitamin. Mm. Guess what, babe? I got a Charles told me he has my award, so we just got to set up a dinner. He's looking at somewhere here in Connecticut. Now, what I'm hoping he does is if we schedule something at Jack's, because I'm still trying to get business with him, and that's about 5 million. Love you too. Um, so where was I? Damn, I done forgot what I was. Oh yeah, so my revelation. I was sitting with a client, and now with the range of clients that I have, I understand, um, you know, buy term, invest the difference, whatever, whatever. But so JT, the pocket watcher, had an episode where he was talking about infinite banking, and there's a lot of insurance agents who do not get. Whoa, it's bad. It's real bad. And so, babe, Char Willie, who's one of my, I haven't yet given a name to, my subscribers, but she said hi. Nikki said hi. So the yeah, the knowledge, what it is that agents are just getting thrown to the wolves, and they're just getting told, hey, here, do these concepts. And unfortunately, there are agents like me who know how to do what, and what they do is they take advantage, right? So they tell you to push term, and it makes so much sense. Here's why term does make a whole lot of sense for the average American, because it's cheap and it's a whole lot of dollars of protection. Now, here's the caveat people don't think about, because term insurance is inexpensive to the consumer, and a large face amount or death benefit or amount of money are at risk for the insurance company, they scrutinize term life insurance a whole lot more than they scrutinize whole life insurance. See, they'll let you get through with a whole life insurance policy with certain conditions and everything. They're not going to let you get through with term life insurance with anything. Why? Because term life insurance is a lot of money for a little bit of money to them, right? So, I'll give you an example. I have two clients right now who are both applying for about $2.5 million of death benefit. Right? Now, and they're the exact same age. They are both African American males, 45 years old. And they're both in very similar health, very active men. They're both applying for the exact same death benefit, $2.5 million. But get this, one is applying for $2.5 million in term life insurance. The other is applying for $2.5 million in indexed universal life insurance or investment grade life insurance. Now, get this, the one who's applying for $2.5 million in term life insurance. Hold on. Now I need to bring up my. I'm going to go to my computer and I need to see what I have. Babe, you can stay right there. I'm coming back. I am going to. I can't show it to y'all because it's got his name on it, but I want to see the difference. Right? So, one. Oh, you know what? I got it in my email. So, here's the difference, right? Uh, between term and whole life insurance. So, remember, I told you that I have uh, a gentleman, and ironically enough, they're both only paying into it to for 20 years, right? Now, the one who's buying the term for $2.5 million, right, is paying $3,670 a year. Okay, over the course of 10 years, he will have paid into the policy $36,697. Right? And if he dies, his family gets $2.5 million. Right? But here's how this stuff works. One second here. Right? So the other guy who's applying for 2.5 million in whole life or index universal life, right? His premium, and this is why I understand. You said 300 a month, Miss Queen? Yeah, 300 a month. Right? I'm sorry. I tend to go by annual premium. But yes, 300 a month. Right? And that is for $2.5 million death benefit of a term policy. Right? Now, if he dies, his family gets $2.5 million. And that's over the course of 20 years, because it's a 20-year term. That's the most commonly purchased length of term, is 20 years. So over the course of 20 years, he will have spent, what is this? That's year 10. Year 20, he will have spent $73,394. Okay? Yeah, you pay for insurance with after-tax money. Because it's a private insurance. So now, the guy who's paying for the $2.5 million in whole life is paying $40,000 per year. However, at the end of 20 years, he won't have $2.5 million of death benefit. He will have $3.1 million of death benefit and $746,000 of cash value. What do you mean, what will they get after taxes? So the death benefit is tax-free. Okay, I see what you're saying, before taxes. No. I thought you were saying the $300 a month is before taxes. Life insurance proceeds are tax-free. So, Miss Queen, right? Say, Miss Queen, you and Mr. Queen are married, right? And he has a term life insurance policy. If he passes away, that $2 million goes to you tax free. You don't pay a dime in taxes when you receive it. Mr. Queen. It's funny. But yeah, so that would be that. It's tax free. Now, the flip side is, again, this other gentleman, after 20 years, has paid $640,000 into the policy because he's paying $40,000 per year. However, at the end of 20 years, he not only has a $3.1 million death benefit, even though he was paying for a $2.5 million death benefit, he also has a cash value to borrow against of $726,000. So if we do math, right? He paid, here's how cash value works, right? Because they sell it to you as a negative. When it's a positive, it just takes time. See, after a term, after 20 years is up, that's all, that's it. But whole life becomes cheaper the longer you have it, right? So I'm doing math. Now remember, math wise, the guy who paid for $2.5 million in term, over the course of that 20 years, if he dies, so from 45 to 65, if he dies, his family gets $2.5 million. But if he don't die, his family don't get nothing, and he don't get nothing. But he gave the insurance company $73,000. It's over the course of 20 years, though, right? Now, this guy, he, over the course of 20 years, paid the insurance company $640,000, right? But if he dies across that 20 years, his family gets at least at least the $2.5 million. But let's say he lives 20 years, right? And because with the term policy, at the end of the term, you're done paying for it. The insurance is done, so you don't got nothing else. So if you're 66 and die, your family don't get a dime, and there's nothing you can do about it. Now, with the whole life, yes, he's paying $40,000 a year. So over the course of 20 years, he paid $640,000 into the policy. Yeah, so if old dude don't die, he just loses money. Right? So when you buy term insurance, you want to die. Otherwise, you don't want to, that's not exactly the case. Again, term insurance is really a good thing for people because there's also something called return of premium term. I'll get into that in a moment. But so again, this other guy, for the same $2.5 million death benefit, same age, 45 years of age, and about the exact same health. They're both athletic men. $640,000 into the policy after 20 years. However, after that 20 years, if he didn't die, oh, by the way, he stops paying for it, but the policy keeps going. So if he don't die at 65, right, when he turns 66, when he turns 65, if he dies when he's 66, his family gets $3.1 million because the death benefit grew. Why did the death benefit grow? Because he had cash value that's attached to it. So with that cash value, again, at the end of 20 years, right, he doesn't spend another dime, but he paid into it way more than the other guy, right? The other guy only paid into it $73,000. And hey, he got to live. But this guy did the same thing, but he spent $640,000. Remember, I told you I compare life insurance to Mercedes-Benz classes, so we're going to get into it, right? So, now, he spent $640,000 into the policy. Everybody, I want y'all to do like savings minus debt. I want you to take out your calculator. And in your calculator, I want you to put 640,000. Right? Just put 640,000 in the calculator. Right? Now, over the course of that time, he's built cash value in his life insurance policy. So at that 20-year mark in his life insurance policy, cash value, which means he has access to it by borrowing against it, or he can cash the policy out and liquidate the money. You guys ready? If you put in the 640,000 in your computer, I want you to put minus 726,592 and then hit equals, right? And when you see that, you should see negative 86,592. So now what does that mean? That means over the course of the last 20 years, the guy who bought term insurance spent $73,000. The guy who bought whole life got paid $86,592 to make sure that when he dies, his family gets $3.1 million. Right? Yeah, exactly, Shar. So that should be negative 86,592, which if you go to your bank account and you have negative 86,592, that means that you owe the bank $86,592. So if in here, in this insurance policy, there is a fact that you spent $640,000, but you have access to $726,000, that means that the insurance company basically paid you $86,592 to make sure that when you die, your family gets at least $2.5 million. If the math ain't mathin', hold up. Let's see if I can do this right quick. Alright, there's my Mont Blanc. I don't know. So there's Mont Blanc. This is Mont Blanc Legend. This shit slaps. And then this is Mont Blanc Legend Red. This shit slaps. And then it's ironic because I was on a podcast and the women were talking about amazing scents on men, and I have all of them. And then Burberry Hero. I haven't even opened this yet. Also, Kenzo. If you could get Kenzo flour is banging. And then, like I said, I'm the type of insurance agent who tells you buy 3 pairs of Jordans a month. But instead of buying 4 pairs of Jordans, buy 3. Invest with me what you would spend on that 4 pair of Jordans, and I'll teach you how to get 3 pairs of Jordans a month every month for the rest of your life. KP was good. Queena was good. So, again, we're going to do this math. So I can't show you the customer's name, but again, boom, 40 grand a year is what he pays into the policy, right? Alright. So it's a $2.5 million death benefit, right? But again, at the end, and he's actually only paying into it for 15 years. But I compare it to see, he's only paying into it for 15 years. That's what called premium outlay is right here, right? So I have it set up so because I don't think you should pay for whole life insurance for your whole life. But so he's paying into it until he's 60, right? So in that situation, again, right here, at the end of 20 years, again, he ain't spent 20 years worth of money. The other guy spent 20 years worth of money. But again, he spent 640,000 into it total, right? He's got cash value of 726,000 to borrow against, and 726,000 if he cancels the policy. So when you're looking at insurance, you always want to look at what people show you is just the cash value. You always want to know what the surrender value is, the cash out value, right? But if you're like my client, you're not worried about, yeah, I was thirst trapping. Right? You're not worried about actually the cash out value. You're worried about what you have to borrow against. We'll talk about that in another strategy session. But again, so you see here, 640K, right? $726,000 to borrow against, right? So if we do that math, right, that's 640,000, right, minus 726,592 equals negative $86,592, right? On the flip side, right? So this is actually a lesser death benefit. It's a $2 million death benefit, not a $2.5 million death benefit. Same thing, but term, $300 a month. $73,394 is what the dude spent. Right? So now, does term insurance seem cheaper? Right? Because if now let's do a little math there, right? So we got 86,592. 86,592, right? Actually, how do we do this? It's got to be negative. No. Clear. Negative 86,592 minus 73394. So the difference is that the difference in cost between just buying the term insurance policy, which is cheaper, and the whole life insurance policy, which is more expensive, is over that 20 years, the term insurance policy costs $159,986 more than the permanent insurance. Why? Because the permanent insurance policy first the difference in price has to go from 86,000, so negative 86,000, to zero. Then from zero to 73,000. And that difference is 159,000. So the term insurance policy costs you 160 grand more than the permanent policy. But the permanent policy seems so much more expensive, especially when I'm talking to black folks. We can't grasp it. Oh my God, why would I buy this perm? Man, listen, I'm trying to sit here in this M3 Beamer, in this S-Class Benz, in this Q50 Infinity. No, you can do that. But make sure when you're doing that, you get you a whole life policy so that you can do that at any point in your life. And you can pass it down to the next generation. Right? It's insane what we can get done. So that was it for me, folks. I ain't really I just wanted to kind of chime in on that because I did have that realization that, on the spot live, what's up? Term insurance can be a great option for a person. Now, actually, let's take a look at that, right? So, what I'm going to do here is I'm going to have to do a multitude of illustrations. And the reason why is, let me get in this chat with y'all. Salute everyone. Oh damn, I can't share my screen, huh? I can share my screen, yeah, but if I go live, then I gotta go live through like a StreamYard or something. I could probably do it through Zoom, right? Maybe I'll do that. Hey, y'all want me to come back and share the screen, or are y'all cool with me just well, I guess the numbers really don't matter because you can't really it's not specific to you. So let's continue with it being like this, right? So, alright, I gotta pull up a few different companies because I don't produce for just one company. When it comes to loyalty, I hold no loyalty to the insurance company. I hold loyalty to my client. So I don't, the company does not matter, right? I work with a multitude of companies, and I will sometimes place my client with whichever is best for them. In that situation. Prime example, some of these clients I have with a certain carrier, I may switch them to another carrier because one carrier is not, they're being over scrutinous. Unfortunately, things change with numbers, and then one company or carrier becomes more advantageous than the other. So I'm going to do a quick quote here. Let's do, yeah, we can do it like this. And I've been going for a half hour. Sheesh. Alright, here we go. Oh, I forgot about this. I gotta see what they need on this. We left message for records department. Okay, so now I gotta call this damn doctor's office. What information is missing from there? Okay. I'm sorry, y'all. I'm looking at my back office. Um, Create an illustration. Launch. I am going to. I guess I can use the same client for both. No, yeah, yeah. Let's use myself. All right, let's do like so. So we're gonna see the difference. We're gonna use a 40-year-old male. All right, we're gonna use me. Yes, a tobacco user. And I'm an agent looking for a client. Remember, I told you guys about term insurance, right? Because term insurance isn't bad. Return of premium life insurance. We want the maximum we can get, which is $250,000. State of Connecticut. Get life quote. All right. So with a return of premium term, which is a term life insurance policy that at the end of the term, they actually give you every dollar that you spent into the policy back, minus some fees and interest. So it's not a dollar for dollar thing. Are showing what's going on. Salute. It's not an exactly dollar for dollar thing, but you do get some of your dollars back from the return of premium. Now, it's a little more expensive than a traditional term policy. However, it is an option. And again, one of the things that I'm noticing when dealing with my clientele is yes, there is a permanent life insurance policy, and the reason why term is pushed more is because most people are looking at life insurance not for the financial tool that it is. It's actually an investment. But most people are not able to be investors, so they don't need to use life insurance as an investment. They need to use life insurance as a death benefit. And in that situation, term life insurance is the better option because it's cheaper for a larger amount of dollars. However, we just did the math, and term life insurance is actually more expensive. But again, those scenarios are buying a huge death benefit. Most people who are looking to have a $2.5 million death benefit are going to be comfortable at $300 a month. Now, here's where I want to implore you to be very, 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 very careful. Miss Queen, you notice how when I said $3,600 a year, you said $300 a month. Damn, that's a grocery bill. So let me explain to you guys this about investments. I don't know if you saw my other video the other day. I did a quick behind the scenes. I was actually on the phone with a wholesaler from a company, and I was talking to him about a minimum investment. The minimum investment for the products is actually $25,000. I, at least, am a broker who drops my pants, which means I'll give you the bare base bottom, meaning generally off of this, it's not enough for the company to pay me a commission, but I want to earn your business. So I'll tell you the minimum investment is $10,000. Most people don't know that that's the minimum investment. So $10,000 equates to $834 a month. So if you're a person who cannot afford $834 a month, what the fuck is somebody doing telling you to buy term and invest the difference? You can't invest the difference if $300 a month on term life insurance seems expensive. And I'm not trying to pick on anyone, because I have clients right now who are having struggle paying $20 to $30 a month on life insurance. And it's not because they're struggling doing so, it's because they don't see the value in it. Yeah, dropping your, that's a Wall Street term, Marshawn. I forget that people don't know I'm a Wall Street nigga. Like, I cut my teeth on Wall Street, right? My first office was 100 Broadway. You come out and take two lefts, the nicest right there, New York Stock Exchange, right? My other office, where I was a stockbroker for a company called E.J. Sterling, was at 39 Broadway. The other company I worked at was in National Debt Relief. You know, the big ass company. I worked for them when they had their first $50 million month at 11 Broadway. You could walk across the street and grab the brass bull by the balls. Now, a lot of Negro folks, when I say that shit, especially men, oh, I don't know about grabbing the bull by the balls. Well, guess who grabs the bull by the balls a lot in America? The Asian community, Chinese, and they're kicking everybody's fucking ass in this country when it comes to economics. So I ain't worried about grabbing a brass bull by the ball. Maybe some niggas need to do that shit and stop worrying about everything being homosexual and all your manhood bullshit. What's up, Toya? I ain't trying to go off. See, I don't get me to going off now. You know I will, but that shit is crazy. And you know I excuse my language, but the reality is, and shout out to Dr. Mark and the flawless mentality. You know, he said, "Listen, man, God said, come as you are," which means if you curse regularly, don't be getting around people and being like holier than thou. Don't get around God and be not cursing. God gonna look at you and be like, "Who is this? Nigga, you be cursing and shit. What the fuck? That's how you talk. I don't know who this, oh, well, sir, I mean, and, nigga, that ain't how you talk. I'm God. I see it all. You forgot. Anyway, I'm not religious and I don't know why God just popped up like that, but I guess God works in mysterious ways, right? So anyway, back to my diatribe about the insurance. So a return of premium for a 40-year-old tobacco using male, and tobacco use triples your price generally. But I smoke tobacco, right? Now, there are things and factors, and this is why it's better to get insurance while you're younger than when you're older, because what do you think happens to you as you gain age? You get sick, right? You're never as healthy as you are today, right? When you were 18, you are a lot healthier than you were at 28. You're a lot healthier than you'll be at 38. You're a lot healthier than you'll be at 48. Even if you do keep healthy, guess what? Just for sheer attrition, the fact that you're alive that long means that you're also closer to death. But your health has a huge factor, especially people in our age range, 45 and under. Our health is all fucked up. High blood pressure, diabetes, smoking cigarettes, teeth falling out, fucking eyes turning purple. We got all kinds of shit, these microwave babies. Probably because of too many honey buns and Capri Suns when we was young. And Lunchables. He says, I'm definitely feeling that age walking me down. Right? Well, that age increases your price. So imagine when you're a tobacco user, right? That basically triples your age. So right now, the prices of a 40-year-old, because he's a tobacco user, technically he's probably paying the prices of a healthy 60-year-old who don't smoke. That's fucked up, right? Just for the simple fact, gotta light that Newport. Yep, gotta light that Newport. Well, guess what? All right, you wanna light that Newport? We gonna spank your ass. Big time. Triple the price. Ruthless. So, for a return of premium $250,000 death benefit, you will get back at the end of a 20-year term 258 I'm sorry, you will spend $258.02 a month. Now, again, there's a thing called banding. So the higher amount of life insurance death benefit you buy, the lower the cost actually is because you're in a band, right? Now, again, I told you this also triples the price. Remember, for that 40-year-old, well, he was 45-year-old healthy male, a $2.5 million death benefit was $350 a month. This is a return of premium $250,000 death benefit. So 1/10 of what the other guy was buying, and this one is only $100 a month less. Smoking is real bad. For 1/10 of what the dude the same age was buying in a term. Now again, this is a different type of term. This is a return of premium. But we'll see what it will be like. Let's see what $258 a month is times 12. That's $3,000, $3,096. So now, $3,096 times 10. Right? So that's $30,960. Right? So 3,096 times 20. So you'll get back $61,920. On the flip side, if you were to use that same scenario on a permanent life insurance policy, healthy non-tobacco, or I'm sorry, a healthy tobacco using, other than that, he is a healthy tobacco using 40-year-old male. At the end of 20 years, he's put into the policy the same $250,000 death benefit is going to cost him $1,221 a month, or $14,660 a year. And over the course of 10 years, he spent $146,604. But he's got access to $148,419. Wait, let's do some math again, right? Because at the end of 10 years with the term policy, you either die, because if you cancel a return of premium term, you don't get any of your premium back. However, if you cancel a whole life policy, depending on where you are in that whole life policy, you may get some of your cash value back. Well, in this one, 10 years in, not even 20, but 10 years in, he spent $146,000, but he has access to cash value of $148,000. So that means in the first 10 years, he got paid 2 G's for making sure that when he dies, his family gets a quarter mil. Now, the other guy, right, he just paid into the policy, right, over the course of 10 years, that 30 bands. But if he cancels it, he don't get jack, right? Now, if he dies, his family gets a quarter mil. But remember, this is a 20-year term. So, let's see what happens at the end of 20 years. At the end of 20 years, if the dude dies, his family gets a quarter mil, right? If he lives, he gets back $61,920 because that's how much he spent over the course of last 20 years. But he ain't got no more life insurance. And he's 20 years older. Remember what I told you about age. And over the course of that 20 years, if he kept smoking, you think he got healthier or nah? He probably now got COPD, sleep apnea, might be on a air thing, all that, right? So you think it's going to cost more or less for life insurance at 60? You think at 60, if he's old and got COPD, he's probably not working, so he's on SSI, on a fixed income. You think he got more money to spend or less? Even with this 61 bands he got back. Right? Because that's probably going to go to some bills. Well, he'll probably have less money, Shar, because now he'll be in an age range where he's going to need to get things like Medicare or Medicaid. I can't recall. I'm not good with healthcare, so I don't know what that is. But he'll be able to get, those kind of benefits. So generally, he's on a fixed income. So he's not going to have more money to spend on other stuff. But it's going to, like you said, it's going to cost him more. Substantially. Now, the thing is, it's beneficial. You did get back $61,920. So that's the cool part of return of premium. Yeah, most likely Medicare. That's right. Now, let's take a look at, 20 years in on the whole life. Oh yeah, no, that's all right. That's what I figured when I read it. I was like, oh, she was probably talking about the thing that's gonna cost them more. I just realized that I read that wrong, Char Willie. That was my mistake, so I apologize. So, at the end of 20 years, he came out of his pocket $293,208. Now remember, at the end of 20 years in the term policy, he only came out his pocket $61,920, which is what they're getting back. Give me one. I'll respond to that in a second. That's my mom. Right? Now, at the end of 20 years on the whole life policy, he came out of pocket $293,208. But let me just write this down so I don't forget this. Only because... what is it, 61K? 61,920. That's an old picture of me and the wife. That's one of my favorite pictures of us, actually. I have it in my office, which is in my house. So, 61,920. So, homie came out his pocket, right? $293,208. That's what actually came out of his pocket, out of his bank account, and got debited into the insurance company. However, the insurance company was holding that money to the side for him. You know how, like, in the hood, when you give your grandma some money and she just hold that shit to the side? I'll hold the money for you, baby. And she hold that money to the side for you? Galgamy, what's going on, brother? Right? So that's what life insurance is. Life insurance is your grandma who holds the money to the side for you. Right? So and she putting in on it for you. You know, grandma, here, baby, you want some cookies? Here, go get yourself something to eat. And then she putting money in for you. Because grandma understands the power of this shit. Right? So you put out $293,208 out of your pocket and gave it to grandma, right? Well, grandma was putting it up. And what grandma did was turn that $293,208 to $444,673. So, in essence, the insurance company paid you $151,465 to make sure that when you die, your family gets $250,000. However, this is an increasing death benefit. So, if I turn the camera around, right? Let's do this here. Right? If I turn the camera around, boom, your death benefit initially, right? We'll do it like this, yeah, because here's the client, right? I did it for me. 39-year-old, or 40, so a 39-year-old male, right? 40-year-old male, right? Paying for $250,000 death benefit, right? $1,221 a month, right? Cost him $14,000 a year. $1.46 is what came out of his pocket over the course of the first 10 years. But at the end of that 10 years, he can borrow against $148,000. So his family, if he dies, gets at least $250,000. But because of that $148,000 he built up, his family would get $398,000 if he dies. But technically, if he needs to access that, that means that he got paid 2 G's. Now let's look at 20 years, because that's the normal, most common length of term. So 20 years he spent, right? Alonzo Hall spent $293,208 out of his own pocket. Remember, like I said, you're stuffing that money, you're giving it to grandma. So grandma turned around and turned that $293,000 into $444,673. It also increased your death benefit, so if he dies there, his family gets $694,000. Right? Hold on here. I don't know what happened. Did it... Oh, shit. Why'd my live stop? Oh, okay. I don't know what happened there. Did I... Am I not live anymore? Okay, I'm still live. I don't know what happened. My chat got disabled for a second there. Well, on my phone. I don't know why. So I can't see what y'all are saying if y'all are leaving comments, so I gotta come to the... So what if you get to year 19 and the doctor says you're healthy? Oh, well, there's nothing you can change about it, the doctor saying you're healthy at year 19, unfortunately. It don't matter with the whole life. You're locked in. When you're locked in, you're locked in. Right? So, at year 19, it's not going to matter much because, I mean, it'll be cool when you reapply, but it won't really have anything to do with the current policy in force. So you spent $293. You gave that money to grandma. She turned it to $444. That $444 is a $694 death benefit. Right? But if we do math, 293, 208, right, minus 444, 673 equals negative 151. So that means that the insurance company paid you 151,000 because this minus this equals this. So that means that you was pumping that money into grandma's pocket thinking, oh man, this is expensive. Grandma was like, yep, keep giving me that money, baby. I'm going to just make it grow for you. And grew it. Now, you've got to spend, for most insurance agents to set this up like this for you, you got to spend at least $1,000 a month. And for it to actually work, you got to spend at least $1,000 a month. So if you commit suicide. No, so insurance has something called the suicide clause. So if you commit suicide at any point during your life insurance policy, that nullifies and voids it. If you die during what's called an act of war, such as 9/11, the insurance company does not have to pay out the insurance policy. If you die during the commission of a felony, let's say you robbing a bank or you shooting at niggas, Your insurance does not have to pay out. So, again, he got paid bread for that, right? Now, in this scenario, 20-year return of premium term is $258 a month, right? So we did that math, right? So 258.02 times 12, right? That's $3,096. $3,096.24 times 20 is $61,924. Right? Would you rather have access to $61,924 or 673 dollars? I think we want the 444 because then you can use this as collateral to go buy a house. Because everybody, I want to buy a house. This builds equity better than your house. I don't want that life insurance. You want to see it? Let's look at a 30-year term because that's a common term insurance policy too. So the 30-year is a little cheaper. It's $232 a month. So the 30-year is a little more beneficial. So for Alonzo Hall, a 40-year-old tobacco-using male, $250,000 for a return of premium. And I'm gonna show you all the cost of a regular term as well. So 232.41 times 30, right? Oh shit, no. 232.41 times 12, 2788.92. All right. So that's 83,667. So 83,667, 60, 30, 20. Right? Now, let's see if we just do regular term life insurance. Update quote. Okay. So we're gonna do again, just the term life quote. I don't know why my chat ain't coming up on my. Yeah, my chat ain't coming up on my phone. All right. I think I'm back, y'all. I had a phone call. Am I back? I don't know. Yeah, I'm back because I could see my screen screwing up. Let me do like this because this means y'all probably can't see me either. There we go. Well, there we go. Bada bing. So, where was I? So, this is a term life quote for a tobacco using male. So you'll see here, generally they'll show you preferred, and generally TV commercials will show you the 10-year term for preferred, right? So preferred means that, yeah, you happen to smoke cigarettes, but you still got the health of Kobe Bryant. Well, maybe not Kobe Bryant, let's LeBron James, right? But they're showing you the cheapest, which is a 10-year term. Why is 10-year term super cheap? Because most people outlive it. Why is my... Okay. Hopefully I'm still live for y'all. This is a little frustrating. My doggone old sole provider, what's going on, bro? So if you commit suicide, do they get the money if it's term? Yeah, so, yeah, there's a suicide clause. You can't commit suicide at all. So let's look at a 20-year term for a a standard tobacco male. So we're gonna look at standard, right? I always look at standard because standard is normal people, whereas preferred is not normal people. So a 20-year term for $250,000 is $89 a month. So 89.98 times 12 right? So that's 1079 times. All right, guys, I'll be right back. This keep freezing on me. Hold on, let me see. Guys, put a one if you can see me or see what I got going on, because this keeps freezing on me, on my phone at least. I'm gonna stay in here for a second. Okay, y'all can still see me. All right, so it's just delayed on my end, no doubt. So, 20-year term life is $89.98 a month or $10.72 a year. So over the course of 30 years, you spent 32 grand. But at this rate, you get nasta jack back if you die, if you don't die, right? So a 30-year term is 146.08 a month. 146.08. 146.08 times 12. So that's 1175 times 30. Right? So that's $52,000 that you spent over the course of 30 years. But at the end of that 30 years, if you don't die, you don't get Nasta Jack back. So you have to die for your family to get $250,000. At least with a return of premium term, at the end of 30 years, yeah, it costs you a little bit more. It costs you 30 grand more, but you get all that money back. In the whole life policy at the end of 30 years, you came out of pocket $439,812. Seems like a lot, but remember, you stuffing that money to grandma. Oh, by the way, them other scenarios, your death benefit stayed at $250,000. This scenario, your death benefit keeps growing. You only paid for two, but your death benefit keeps growing. So here at year 30, you've got a $1.2 million death benefit, aka generational wealth, homie. And you got access to $967,000. So if we do the math, 439,812 minus 967,047 equals negative $527,235. So that's quite a bit of money. So that means that the life insurance company over the past 30 years paid you $500,000 to make sure that when you die, your family at this point gets, let's just say that your family only gets, but now your insurance company paid you $500,000 to make sure that you give your family $250,000 when you die. And this one, you don't have to reconsider, you don't have to change, you don't have to reapply, it's locked in. Now, say after 30 years, you say, you know what, I don't want to pay this no more. You don't send them another dime. All it will do is pay for itself out of the cash value. So as time goes on, if you stop paying, yeah, the death benefit will go down because the cash value will go down. But if you keep going into it, it just keeps growing and growing and growing. Now, there's some strategy with that too. We'll talk about that in another video. So, ladies and gentlemen, it's your boy, the Insurance Junkie, your fiduciary fella, and I have come back again and whapped and tapped on your head with another ADH wealth solution. With that being said, ladies and gentlemen, wipe ass, work in progress every day and see success. Wipe ass, work in progress every day and see success. Wipe ass, work in progress every day and see success. I want you to think about that. And while you think about that, remember, if you do nothing, nothing changes. And as always, when people challenge you, they don't challenge you to challenge you, but they challenge you to challenge you. Accept the challenge. Salute.